Have you ever wondered what's really going on behind the scenes at one of these huge global health companies? Beyond the headlines. Or maybe how a really complex organization like Cigna navigates massive market shifts and manages all its finances. Well, today we're doing one of our deep dives. We're going into the Cigna Group, and specifically, we're unpacking their quarterly report, the 10Q, for the period ending June 30, 2025. Our mission really is to cut through the jargon, connect the dots for you and pull out the most important bits of insight. We want to give you a clear, pretty comprehensive understanding of how they've been doing recently, their big strategic moves, and their overall financial health. Think of this deep dive as, well, a shortcut to getting really well informed about Cigna's operations and how they're setting themselves up for the future. Right, let's crack open this report. Let's see what's actually driving Cigna's performance. Looking at the consolidated results, what's the big headline for the first half of 2025?
Yeah, okay. So what immediately jumps out is the revenue growth. Pretty striking. Total revenues for the quarter ending June 30, 2025, they climbed to $67,178 million. That's an 11% jump from the same time last year. And if you look at the full 6 months, it's even bigger, from about $118 billion in 2024 up to nearly $133 billion in 2025. That's a solid 13% increase.
Okay, so significant growth on the top line, but from a shareholder's perspective, how do we square that with profitability? Does that suggest maybe some short-term headwinds, or is it more of a long-term strategic thing playing out?
That's a really crucial question, actually, because while revenues were definitely up, the shareholders' net income for that same quarter, the 3 months ending June 30th, was, well, largely flat. It came in at $1,532 million, just slightly down from $1,548 million in 2024. So this difference, strong revenue, flat quarterly profit, it kind of tells a story, right? Maybe strategic investments or some one-off things are soaking up that top-line gain. But, and this is important, if you look at the bigger picture, the 6-month view, net income saw this huge 125% increase. It went from $1,271 million in 2024 up to $2,855 million in 2025.
Wow, 125%.
Yeah, and the diluted earnings per share, it followed that same pattern. Up 5% for the quarter, $5.71 versus $5.45. But then a massive 138% jump for the 6 months. Went from $4.43 up to $10.55.
Okay, so that big 6-month number suggests maybe those quarterly pressures are temporary or part of the plan.
Exactly. Points towards something more strategic, maybe absorbing costs in the short term for longer gains. To really get it, though, we need to peel back the layers and look at the individual business segments.
Okay, let's do that. Let's start with what seems like their powerhouse right now, Evernorth Health Services. First off, what exactly does Evernorth do inside Cigna, and how did it fare this past quarter?
Right. So Evernorth is Cigna's integrated health services arm. Think of it as the bridge connecting patients, pharmacies, and providers. It includes their pharmacy benefit services, managing drug claims, home delivery pharmacy, and also specialty and care services. That part focuses on those really high-cost specialty drugs for complex conditions and other clinical care programs. Financially, Evernorth is, well, it's still a major growth engine for them. Adjusted revenues grew significantly, up 17% for the 3 months ending June 30th, hitting almost $58 billion. And up 16% for the 6 months, reaching over $111 billion. Pre-tax adjusted income was also up by 5% for both the quarter and the 6-month period.
That kind of sustained growth from Evernorth really stands out, doesn't it? What does that tell us about Cigna's broader strategy? Is Evernorth basically becoming the core engine? And what does that imply for the other parts?
Oh, absolutely. It signals a very clear strategic focus. Yeah. The report points to a few key drivers. Strong growth in specialty pharmacy within that specialty and care services group. That added about 8% to the quarterly income growth and 6% to the 6-month growth. Then you also had better contract affordability and just more customers in the pharmacy benefit services part. That added another 3% to income growth for both periods.
Okay, so multiple engines within Evernorth driving it.
Right. Now, this was offset a bit by strategic investments they're making, to support future growth in both areas. So they're reinvesting to keep the momentum going. It's not just impressive growth. It's like a perfect example of how strategically managing drug costs and expanding services is really fueling that engine. It positions Evernorth right at the center of Cigna's future, it seems.
Okay, Evernorth's story is definitely one of strong growth, strategic focus, but like we hinted, Cigna's got different parts, and not everything's on the same path. Let's switch gears to Cigna Healthcare, especially after that pretty significant strategic move they made. This segment includes U.S. healthcare and international health. What happened there?
Yeah, this is where you really see that big strategic shift hitting the numbers. Cigna Healthcare's adjusted revenues actually went down by 18% for the quarter. ending June 30th, landing at about $10.8 billion. For the 6 months, it was down 4%, and the pre-tax adjusted income also took a hit, down 9% for the quarter and 6% for the 6 months.
Whoa, that's a really stark contrast to Evernorth. So, why the decline? What's the story there? What does it signal strategically?
Well, the main reason, the big one, is that strategic move we mentioned, divesting or selling off their Medicare Advantage and related businesses. They sold it to Healthcare Services Corporation, HCSC, back on March 19th, 2025. This was clearly a deliberate choice to streamline their
Right,
business.
focus maybe.
Exactly. And that sale massively impacted Cigna Healthcare's revenue and, maybe more visibly, their U.S. healthcare customer numbers. They dropped by 33%, from 3.8 million down to 2.5 million compared to last year. Interestingly, though, their international health customer base actually grew by 4%, so there's still strength in that specific market.
Okay, so the divestiture is the key driver for that segment's numbers. What about things like medical costs?
Good question. We also saw the medical care ratio, the MCR, go up. It increased by 90 basis points for the quarter and 150 basis points for the 6 months. Now, for context, 90 basis points means their spending on medical claims went up by 0.9% relative to premiums. Sounds small, but on their scale, it's significant.
And why did that go up?
It was mainly due to higher stop-loss medical costs. That's where Cigna covers really large, sort of catastrophic individual claims. And also, their SG&A selling, general and administrative expenses, that ratio increased too by 30 basis points for the quarter. About 120 basis points of that increase was directly linked to the HCSC deal's impact, although some revenue growth elsewhere helped offset part of it.
Got it. So, beyond how the segments are performing, understanding how a company like Cigna manages its money, its capital structure, is really important for you, our listener. So, what's their strategy for managing capital, and how liquid are they feeling after these big moves like selling off a whole business line?
They have a pretty diverse set of capital resources. They rely on, cash, investments, obviously strong cash flow from operations. Plus, they use commercial paper programs. It's basically short-term borrowing from the market, like a temporary loan.
Yeah.
And they have revolving credit facilities, which are like big corporate credit cards they can draw on.
And what are their priorities for using all that capital?
They lay it out pretty clearly. Investing in tech for new solutions, keeping strong financial ratings for their subsidiaries. That's crucial in insurance. Also, managing their debt, funding pension obligations, paying dividends, looking at potential strategic acquisitions, and, importantly, returning capital to shareholders through share buybacks.
Right, a mix of investing back in the business and rewarding shareholders.
Exactly. It's a calculated balance between being financially careful and keeping shareholders happy.
Okay, you mentioned share repurchases. What does the report say about that, especially using the money from that big HCSC sale?
Yeah, they bought back $2.6 billion worth of their shares during the first 6 months of 2025. Now, that's actually down from $5.0 billion they repurchased in the same period last year. But what's really interesting is that the report notes the proceeds from selling the Medicare business to HCSC were primarily used for these share repurchases.
So selling off one part of the business and using that cash to buy back shares, effectively concentrating ownership.
Precisely. It signals a clear move to streamline and boost shareholder value that way. And on the debt side, they were pretty active too. They paid off $700 million in notes that were due in 2026 early, and they also repaid $900 million in notes that just matured in April 2025. So actively managing their debt load.
Proactive management. Okay.
Yeah, and they also set up a new $6.5 billion 5-year revolving credit agreement in April, which gives them access to funds until 2030. It really shores up their liquidity.
Yeah.
Their debt to capitalization ratio, basically how much debt they use to finance their assets, was sitting at 43.3% as of June 30th. That's a number they watch closely.
And you mentioned dividends earlier. What about those regular payouts for shareholders? Are they keeping that commitment?
Oh, absolutely. On July 22nd, 2025, the board declared a third-quarter cash dividend of $1.51 per share. That's actually higher than the $1.40 they paid the previous year. So it signals not just a continued commitment, but an increasing one.
Good news for dividend investors then.
Definitely. And one other related point, that Evernorth performance guarantee liability is stood at $1.4 billion as of June 30th, which is down from $1.9 billion at the end of 2024. This reflects the money they set aside for commitments to clients based on hitting certain service levels and discounts. Seeing a decrease suggests they're managing those obligations effectively, too.
Okay, moving beyond the day-to-day operations and capital structure, a company's investment portfolio and the risks it flags, those give us really vital clues about its long-term stability and strategic thinking. What can you tell us about Cigna's investments?
Sure, Cigna's investment portfolio is quite diversified. It includes things like debt securities, commercial mortgage loans, and other long-term stuff like securities and real estate partnerships. Their main debt securities portfolio actually decreased by about $1 billion, from $9.4 billion down to $8.4 billion. That was largely linked to that HCSE transaction we keep mentioning.
Makes sense. Selling assets would reduce the investment pool.
Right. Now, technically, this portfolio is in what's called a net unrealized depreciation position, which basically means, on paper, the current market value is less than what they originally paid.
Mostly due to interest rates going up.
Exactly. Rising interest rates push down the value of existing fixed income bonds. But it's crucial to remember this is unrealized. It's not a loss unless they sell. And they point out that 87% of this portfolio is still investment grade, so the underlying quality seems solid. They also have a $1.3 billion commercial mortgage loan portfolio. It's made up of about 40 fixed-rate loans spread across different property types and locations. Similar story here, the carrying value is higher than the market value because of interest rates. But the company says they're confident because the underlying real estate is high quality and the income from the properties comfortably covers the loan payments. That's the debt service coverage they mentioned.
And does their investment strategy reach beyond the U.S.?
Oh, yes. If we look at the bigger picture, Cigna also holds a big 50% ownership stake in an insurance joint venture over in China. That venture has its own investment portfolio worth about $70.1 billion. It includes a mix of debt, stocks, long-term deposits. So it clearly shows their diversified global footprint and strategic interests beyond just the U.S. market.
Okay, so a complex global business. Given all that complexity, what are some of the key risks Cigna is highlighting? Things that could potentially impact their future performance?
Yeah, they regularly talk about a whole range of uncertainties, as you'd expect. Beyond just market conditions messing with their investments, they really emphasize needing to constantly adapt. The healthcare industry changes so fast, right? And price competition is always intense.
Always a factor.
Always. Then there's the inherent risk that medical claims could come in higher than they estimated. That's just part of the health service game. Maintaining good relationships with doctors, hospitals, and especially the big pharmaceutical companies is also critical. And of course, the ever-present threat of cyber attacks is mentioned. Plus, they specifically call out risks related to using newer tech like AI and machine learning.
Interesting they mention AI specifically.
Yeah, suggests they're actively using it and aware of potential pitfalls. They also mention geopolitical events, global instability, and the outcomes of various lawsuits and regulatory matters, including things under the Federal False Claims Act, which is always a watch item for companies dealing with government healthcare programs. Basically, their forward-looking statements section is a reminder that predicting the future in this business is inherently tricky.
Absolutely. Well, that brings us to the end of our deep dive into the Cigna Group's Q2 2025 financial report. We've journeyed through their different business segments, really understood the impact of that huge strategic move, the HCSE divestiture, and explored how they're managing their capital and investments. It's pretty incredible how much insight you can pull from these official filings, especially when you know where to look and have an expert guide like yourself helping unpack it all.
Indeed. When you really dissect these documents, you see Cigna clearly as a company undergoing a significant strategic transformation. They're actively navigating the market, managing huge amounts of money, and really reshaping their business model to zero in on what they believe are their best growth opportunities.
So what does all this mean for you as you think about the future of healthcare, as you reflect on Cigna's journey selling off major parts, doubling down on others like Evernorth? Maybe consider this. How might this trend of strategic divestitures and targeted investments reshape the whole healthcare landscape for consumers, for providers? What might this mean in the coming years? Is this maybe a blueprint for how other big players will adapt? Something to think about?